Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this highly requested video, we're going to discuss hedging. And we're just going to touch on the basics of hedging and just give some examples and some strategies around hedging. Now, this is a little bit more of an advanced strategy, an advanced understanding. You do have to have some foundation and understanding of stocks, of options, futures, but we're going to try to keep it as basic and simple as possible. So we're going to be discussing the basics of hedging. So what is hedging? Hedging is an insurance-like investment that protects you from risk of any potential loss of your finances. Hedging is similar to insurance. So when you purchase insurance for your home, you pay a premium, and if there's a storm, if there anything that happens, any damage, you get protected, you get compensated. Now at the same time, if nothing happens, then you lose that premium. It's a similar circumstance with hedging. There is a premium that you have to pay, and there's a potential loss of that premium. But if the investment doesn't go your way, then the hedging protects you from losing more than you should have. So the goal with hedging is to reduce the risk of potential loss. Keep in mind, when you do that, you also reduce your potential profits, just like the premium. Hedging does not prevent all negative events from happening. However, if a negative event does happen and you're properly hedged, the impact of the event is reduced. Hedging is a financial strategy that aids investors in curbing the downside impact from the potential of other tradable securities, including stocks, bonds, commodities, currencies, options, and futures. So what are some pros of hedging? The main advantage of the hedge is it lowers the risk of investment. And that's the main goal. If for whatever reason, the market, the overall market drops and your position drops significantly and you had the potential of losing 10%, 20% of your investment. So you invested 10,000 and you would have been down 2,000 because of the way the market went down. Your hedge might protect a great portion of that. So you may only take a small loss due to the hedge. So balancing out investment risk, investors can protect their investment by hedging one security, fund, or even bond against another to curb the risk of losing a significant amount of money on their original investment. So what are some of the cons of hedging? Of course, when you pay for that protection, when you pay for the opposite side, it's like paying the premium. So if your stock takes off, and the same example, let's say you would have made 20%, initially you would have made 20% on that $10,000 to $2,000. That you're not going to get that full 2,000. Maybe you'll get half of it or a third of it. But your potential for profit is also going to be reduced. Risk and rewards are often proportional to one another. Thus, reducing risk means reducing profit. So before we go on with hedging, I want to make sure, just kind of like a brief review on short selling. Short selling is an investment or trading strategy that speculates on the decline in a stock or other security's price. Short selling occurs when an investor borrows a security and sells it on the open market, planning to buy it back later for less money. Short sellers bet on and profit from a drop in the security's price. This can be contrasted with long investors who want the price to go up. So let's take a look at the board here. So on the board here, we have the broker. The broker is whoever you trade with, whether it's Lightspeed, TD Ameritrade, Charles Schwab, any company, that's the broker. Now, some brokers have shares that they lend out. So if you want to short sell, you have to borrow shares. So let's say this is me. I know that company XYZ here is going to drop in price. For whatever reason, whether it's the valuation, I believe that this stock is trading too high or something in the macro is going to affect it. I have a hunch that this stock is overvalued and that it should be trading for a lot less. So I tell my broker, I ask my broker and I borrow 10 shares from my broker. So now the broker lends me 10 shares of XYZ. Now I owe the broker 10 shares of XYZ. As soon as I get those shares, I sell them. They have to be sold right away. They're sold right away in the open market. And you're doing that because, and you're going to want to do that anyway because you believe it's overvalued. So you want to get in while it's selling for a high price. So XYZ is trading for $10 a share. I sell my 10 shares for $10 each. I now have $100. So now in my account, I have $100. So there's my $100 credit in my account. So now XYZ is trading for $10. In the next couple of weeks, it drops down to $5. So now XYZ is trading for $5 a share. So this was the price that I wanted. This is the price that I was looking for. So now I owe my broker 10 shares. I don't owe him any money. There's no cash value. I have to give him back 10 shares. So at this point, with my $100 credit, I decide to buy the 10 shares of XYZ back. So 10 shares of X, Y, and Z comes to $50. So now the broker gets back his 10 shares, and from this $100, I only spent $50, giving me a $50 credit. So after giving back the 10 shares to the broker and paying $50 from it, from the 100 credit that I have, you can subtract the $50 that we spent to buy the 10 stocks, the 10 shares of X, Y, and Z, and we're left over with $50. And that is our profit. And that's how a short seller makes money. So that was short selling. Options are a little bit more complicated. So what are options? Options are contracts that give the bearer the right, but not the obligation, to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract expires. Options are a type of derivative security. An option is a derivative because its price is intrinsically linked to the price of something else. If you buy an options contract, it grants you the right but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. So if you buy a call option, it gives the holder the right to buy a stock. And if you buy a put option, it gives the holder the right to sell a stock. We can think of a call option as a down payment for a future purpose. So let's try to place the concept of buying and selling options in a real life scenario. So let's say we were purchasing a home. Imagine that we can buy a call option from the developer to buy the home, let's say at $400,000 at any point in the next 3 years. So the contract reads, I can purchase the house at any point within the next 3 years at a price of $400,000. We make an agreement and we say this is non-refundable, and the developer wouldn't grant such an option for free. So there'll have to be a down payment to lock in that right. It's the same thing with an option. If you have a certain stock, a certain company that you want to buy in the near future, you can set a strike price, which is the price that you want to pay for it, the date, and you have the option but not the obligation to buy that stock at any point, or you can sell that option, that contract, if it becomes more valuable. So the developer takes the down payment, which is known as the premium, and that's for options. We pay the premium. If the price of that option contract, for example, let's say for the house, the $400,000, he wants to take a deposit of $20,000. That would be the premium. So let's just assume 2 years passed and the developments are built and the zoning has been approved. The home buyer exercises the option and buys the home for $400,000 because that was the contract agreement. That was the contract purchase. Now the market value of that home may have doubled to $800,000. And so that's how the person who made the purchase, that's how they profit. So similarly with options, you can agree to pay for a certain company at a certain price on a certain date. And the majority of option buyers and sellers, they're hoping that that price goes up. It's it increases over time if they're buying call options, and they resell that option in the option market for a higher price. So if they purchased an option for $300 and the price goes up, and now the option is worth $450, they're going to sell that option as soon as the value goes up or whatever their target price was. So what is a put option? A put option is similar to selling or shorting a stock. It gives you the right to sell a stock. This is where sometimes people use put options to protect their position. So the same way you make money when you short a stock because the price goes down, it's similar with a put option. The lower the price goes, it becomes worth more. So some people, they may, for example, buy a put against the S&P 500 just to protect from the fear of the bear market or a correction or a long position. So this is just kind of one example of how people use put options. But there are plenty of people that just buy put options because they want to short a stock. They believe that the price is going to go down, and they're treating it the same way that they would short sell. While there are multiple ways of hedging, we're just going to discuss a few hedging strategies. So one of the strategies is called the collar. So a collar entails buying a put option. We discussed put optioning, then selling a call option. So the same way you can buy options, you can also sell a call option. You kind of write the contract. So by selling a call option, part of the cost of the put option is covered. So if you sell a call option for a certain price, it covers the put option premium. The trade-off is that the upside will be capped. So even if that price spikes up, because of your put option, you're going to not make as much profit. If the index rises above the call option strike price, the call option will result in losses. These will be offset by the gains in the portfolio, the other option strategy. So other option strategies are covered calls, spreads, and straddles. And these are just different options where you may buy a call and buy a put or sell a call, certain spreads where if it drops, the other side that you purchase is going to make some money, which is going to reduce the loss. Some of the recommendation is holding cash. If you feel that there's going to be a correction, hold cash, and this is one way to reduce volatility and downside risk. Diversifying, there's stocks that are just what they call correction proof. They do well and they strive during corrections. While most companies are going down, they do well. Short selling stocks or futures. Now, there are some big companies, like let's say airlines, if they believe oil is going to go up and gas is going to go up and that's going to cut into their profit, they may short oil. They may short certain commodities to protect their bottom line. There's also ways to buy ETFs and other securities that appreciate in price when the broad stock market loses money. And some of the examples are SH, SDS, SPXU. As the SPY, the S&P 500, goes down, crashes, these go up. So buying volatility, the VIX is kind of, they consider it the fear gauge. So as there's more fear in the market and people fear, like for example, inflation and different things, the VIX might increase. So you may want to invest in the VIX to protect yourself against corrections or macro fears in the market. So this is one example here. This is Forex trading. I don't do Forex trading, but this is just to show you that when the US dollar goes up, gold goes down. And when the US dollar goes down, gold goes up. As I discussed, there's some stocks that protect or keep their value during a weak dollar or during recession or during corrections. One of the companies that I have is gold, and that protects me when the dollar becomes weak, then gold increases in price. People fear that the dollar is going to lose value, so they jump to gold. And the same thing happened with Bitcoin, but I prefer to hedge with gold. Or if they believe a company is going to drop or correct, they might buy a put option for the same company. So as that price goes down, their stock value goes down. They're losing money in the stock, but they're making money with the put option or the short position that they have, and that's offsetting their losses. And then when they feel that it's reversing again, they may sell that position and that money makes up for their loss. There's some people that when certain moving averages cross each other, they feel like there's going to be a change in momentum, and that's when they'll get into a position. And there's some people that take the position that if I believe in a company, I don't care about the ups and downs for the next year or 2 years. I'm looking 10 years out and I'm not worried about that. And we're going to discuss one more hedging position here just to kind of like fully understand and have a basic understanding of what hedging is. So let's say we researched a stock, just like when we do our due diligence on certain companies. So let's say we researched two companies. Company A, we did our due diligence. We believe in the company. They have good financials, and we give it a higher intrinsic value, and we believe that this stock price is going to go up. And I did research on a second company, and I believe that this company is overvalued, that it shouldn't be trading so high, that there was false speculation, false hope, overreaction, whatever reason, it's just trading way too high. And I believe that the price should be going, the price is going to be going down in the next few weeks or few months or then within the next year. So I want to take a position in both. I want to go long for stock A and I want to go short for stock B. I trust my evaluations, I trust my track record, and I have faith that my intrinsic value and what I did is going to be correct or high probability. What I don't trust is the instability of the overall macro of the market. So let's say this chart here represents the SPY or the NASDAQ or whatever, and we can see that it's got its ups, and then let's say it goes down 10%, up, down, up, down. This is unpredictable. This is very difficult to predict. And I have faith in what I did here, but I don't have faith in the overall market. So I want to protect my positions here. I'm going to decide I want to hedge. And this is usually like kind of like a hedge fund strategy. So how do I protect myself? How do I hedge? I decide to buy one share of A, which is valued at $10, and I'm going long on A because I believe it's going to go higher. And I short two shares of B because I believe B is overvalued and it's going to drop. So I buy two shares. The reason I buy two because they each cost $5 and it gives me $10 equivalent. And this is just to keep it simple. So now let's say my thesis was right, and let's just say the overall market is rallying and everything is going up, and this goes up 50%, and it's now trading at $15. But the overall market was strong, so this also went up. And let's just say it went up 20%. So now B is trading at $6. So let's assume I decided to close my positions and I sell my one share of A for $15, giving me a $5 profit. And remember, we discussed short selling. So I sold two shares at $5 each. I owed the broker two shares, hoping that it would go down, but it went up. So I had to buy them back at a higher price. So when I sold the two shares initially at $10, $10 credit. Now I have to come $2 out of my pocket to buy two shares at $6. So I buy B for $12 because it's two shares, giving me a $2 loss, but I still make a $3 profit. So this is what we talked about, that we spoke about when you buy that premium. This is the premium, the $2 premium was for the protection. So now let's go the opposite way to see what happens if we incur losses. So let's say we're in a correction and the stock prices go down. We're going down, everything's going down, the whole market's going down, there's a lot of fear. So company A goes down about 20% to $8, and our assumptions for company B was correct, and that drops down to $2.50 a share. So after the market's going down, I want to close my positions. So for A, company A, I sell A for $8 and I incur a $2 loss because it dropped 20%. And we're in a down market, so that's why everything is down. So my thesis for B was correct. It dropped even more, and it dropped down to $2.50 a share. So now I had that $10 credit. Remember, we talked about short selling. $10 credit. I used that $10 to buy back two shares that cost me $5. So I buy back B, so I can give back the broker his two shares for $5. And from that $10, I have a $5 profit. So my $2 loss was hedged by this, giving me a $3 profit during the market going down. And that was just a brief overview on hedging. The topic on hedging can get a lot deeper. There's a lot more intricacies, measuring beta, measuring different things, different strategies, different formulas that try to give the best estimates for hedging. But this is kind of just like an overall basic understanding the concept of hedging as every strategy that you learn about, or if you decide to further learn, is kind of built on the understanding of this. You're basically protecting, you're buying insurance for your position. And that was our video. Thank you for watching. Don't forget to like, subscribe, and comment. Thank you.